Good morning, everyone, and welcome to what I'm sure will be a very thoughtful and lively discussion about some exciting investor research recently conducted by Dow Jones and AdvisorStream. My name is Kareem Rashwan, Managing Director at AdvisorStream, and I'm thrilled to be joined today by three expert panelists to share their thoughts on a range of topics which are critically important to advisors. Before we get to the meat of today's webinar, the state of advice exceeding investor expectations in 2022, I'd first like to introduce our panelists, starting with Michael Kitces. Michael is the head of planning strategy at Buckingham Strategic Partners, co-founder of the XY Planning Network, Advice Pay, New Planner Recruiting, FP Pathfinder, and FA Bean Counters, and publisher of the financial planning industry blog, Nerd's Eye View. Welcome, Michael. Thanks very much for being here today.
Thank you.
Nina O'Neill, who's joining us today from Raleigh, North Carolina. Nina is a partner and investment advisor with Archer Investment Management. Named one of the Investment News 40 Under 40 financial professionals, Nina is also the founder and organizer of the Female Advisor Network, a national membership organization dedicated to empowering female financial advisors and women in financial services. Thanks very much, Nina, for being here as well. Welcome. And last but not least, Carrie Dyer, who is from Dow Jones, who is the Executive Director of Client Solutions. Carrie brings extensive industry experience, both from the publisher and advertising agency sides of the business, in developing effective and bespoke partnerships across a range of marketing sectors with a focus on finance. Thank you very much for being here as well, Carrie.
Thanks. Good to be here.
So we'll get into the research and hear from our panelists in just a few minutes, but first a bit of background on why we did this study in the first place and the methodology used. Very simply, AdvisorStream and Dow Jones set out to get a better understanding of what it is that investors want from financial advisors. So what does that really mean? That's obviously a very broad topic, so we wanted to focus on a few key areas. Primarily, do investors see value in working with an advisor? If so, what kind of value? And if not, why? What factors go into making an investor work with an advisor in the first place? How frequently do clients want to and expect to hear from their advisors? And very importantly, what are investors getting? Where are investors getting their financial information? These are just some of the topics our panelists will weigh in on today, and I'm sure some of the findings are likely going to be somewhat surprising. For myself, I know they surprised me a little bit, and I actually did used to be an advisor for 9 years, so it's nice to see some of these surprisings actually surprise me. So we'll take a quick look at the methodology first that we use for the survey and get into why we're here today and discuss the research findings themselves. So firstly, we surveyed just under 1,300 investors, 1,269 to be exact, across 3 different markets. So the US, Canada, and the UK. And this was conducted over a mix of investors by age, gender, and investable assets. So we really looked at all respondents having to have at least one investment. Doesn't mean they had to work with an advisor. It just means they had to have at least one investment. And these the survey was run across a range of digital properties, including Dow Jones properties, Wall Street Journal, and Barron's, just to name a couple. So that's really the high-level methodology we used. And we'll just get into now what the research tells us before we get into our panelist discussion. So we found that of the respondents, nearly 60% of the respondents indicated that they work with an advisor, that they currently work with an advisor. And what we saw is that, not surprisingly, as wealth accumulates, so does the propensity to work with an advisor. So we look at the different investable asset breakdowns. We see that we asked for a range of investable assets, anything less than 500,000 to over 5 million. And very clearly, you can see here that as investable assets increased, there was a higher propensity to work with an advisor, which makes sense, given that typically as you grow your assets, there's more complex financial planning needs. We also saw that when we looked at a breakdown by gender, that women were more likely to have and work with an advisor than men. So 64% of women versus 53% of men, which we'll get to a little later on in the discussion around why that might be the case. But we do see that there was definitely quite a big gap between men and women as to who typically works with an advisor. So we also asked, do you see any value in planning for your goals with a financial advisor? Now, this one comes as a bit of a surprise to some, I think, maybe not to everybody. But when we looked at the breakdown by age, there's this narrative, I think, that we hear in the industry that the younger generations, Gen Z, millennial, younger Gen X, tends to be a bit more DIY. And that's simply not what we saw from the survey results. We actually found that younger generations are actually more likely to want to work with an advisor and see value in planning with a financial advisor. So you can see really, all the way from Gen Z, what we would label as Gen Z through millennial through to the younger Gen X, they were actually most likely to value an advisor. And almost the opposite of what I think, again, is a bit of a prevailing narrative in the industry. The older generations, boomers and the silent generation, really tend to be a bit more DIY than what may be the perception. Now, of course, as we saw in the previous slides, that likely as wealth accumulates, the idea of managing your own assets, the idea of managing your own wealth becomes a little bit more daunting and complicated. So we saw, of course, on the previous slide, that there was a higher propensity to work with an advisor as assets accumulated. Now, when we look at what the top reasons why investors felt they needed an advisor or why they started working with an advisor in the first place, so not surprisingly, those who did work with an advisor, the most common reason that that they began to work with an advisor is through a referral or recommendation. That was really the number one reason why most younger investors wanted to work with an advisor, where older ones were more likely to turn to an advisor because of a lack of investment knowledge. So you can see from the results here, there was everything from recommendation through to not enough knowledge to not enough time and not wanting the stress. And so, I think almost the knowledge, time, and stress piece can even though they're separate, they can almost be lumped together in a lot of ways as sort of overlapping reasons. And basically, when we look at the different age brackets, again, we see that it is almost an even split between choosing an advisor or working with an advisor because of a referral or a recommendation and not having enough knowledge. When I say even split, I mean almost just between the age brackets themselves. Now, when we look at why, for example, investors did not have an advisor, so we also did want to ask that question because I think it's important for advisors to know why investors may not choose to work with a professional financial advisor. Well, we saw, of course, that there is a high propensity for people who don't work with an advisor to want to invest by themselves. So the DIYers, they wanted to do that with invest on their own. Some found that it was too costly. I think that's more maybe, again, a statement of value and perception. So that's something we'll talk about a bit later on as well. Don't trust them with their money. Again, that may just come down to more of a value proposition discussion. And we also saw that when we look at the different ages, we saw that baby boomers, in the end, were most likely to prefer to be a bit more DIY compared to younger generations. All right, so that age bracket between 65 to 74, 56 to 64, in that range. This was really the age groupings that really prefer to be a bit more DIY. One of the reasons, of course, that we saw in the results, and we asked a few qualitative questions as well to get a bit more diverse responses. I won't go through all of them here, but you can see a few of the responses from some of the from the survey results. Really, just if we take even a look at the first one, they haven't marketed themselves as a valuable service. So this is, again, reasons why investors did not have an advisor. So again, this is going to come down to a discussion a bit later on around what do advisors need to do to really demonstrate their value proposition, to articulate their value proposition with investors and those who don't currently work with an advisor. And when we looked at some of the top reasons by gender as to why someone did not work with an advisor, we did find that in general, men prefer to be a bit more DIY, actually quite a bit more DIY. So 37% of men versus 14% of women said they prefer to actually invest themselves versus working with an advisor. For women, the primary reason given for not working with an advisor was that it was too costly. So again, this might have something to do more with value and a value proposition versus the actual cost of working with an advisor. And for men, again, that was a higher response rate than women. And there was a small percentage for both, again, a little bit higher for men, that they just simply don't trust working with an advisor. So again, maybe that has something to do more with the value proposition that advisors need to articulate and deliver. So we also wanted to know what would convince those without an advisor to really start working with one. Now this was pretty interesting because there's a few of the reasons given here are actually very much in the advisor's control. Now the most common reason as to why someone would want to work with an advisor, what would convince an investor to work with an advisor, is better returns. So again, these are just responses from the survey results. We still are going to discuss what advisors can do to perhaps change some of these perceptions or change some of these reasons. But better returns, that was almost 50% of the responses. Fees was the second highest response rate. So again, some advisors may have control over their own fees, some may not. But communication, level of communication was really, again, which I would also add in the written financial plan piece. Just communicating with clients, that really was a strong reason why someone would want to work with an advisor. What would convince someone to work with an advisor? And this actually is a result that mirrors what we've seen in other studies. This is something that is completely in the advisor's control as well. I think better returns in general may not be certainly not in the advisor's control. So that's something that advisors need to look at and think, okay, well, what can I do? And what are some of the areas that I can add to my value proposition? And communication is one of those areas. Okay, so we'll get into the panel discussion now after going through some of the stats. So just to reiterate, one of the things that I mentioned earlier is that it was about 79% of younger investors aged 26 to 35 see significant value in planning for their goals with a financial advisor. And we're looking at the research showing us that younger investors are least likely to want to DIY it themselves. So Michael, I'll start with you. Is this something that you're also seeing in the market?
Yeah, it's very much something that we've been seeing in the market. I mean, we see it firsthand through XY Planning Network, because literally the organization's focus is financial planning for people in their 30s, 40s, and 50s. But when I look broadly at the landscape, I mean, if I go to the average person on the street and I say, what is the financial lifeblood of your household? No one talks about their investment accounts and their retirement accounts. They tend to talk about their bank accounts and their cash flow. Like the financial lifeblood of the household is money in and money out, and what's moving through our household in the first place, and all of the different things that can come in externally and impact that. And to me, the ironic reality is younger folks have a lot more coming at them than retirees do. I mean, the industry is traditionally focused on retirees, and certainly there are some major retirement transitions. We go through the transition into retirement itself, health declines, potential passing of a spouse. There are a couple of events and milestones that do tend to come in a retiree's lifetime over the 20, 30, 40 years sometimes that they're in retirement. But when we're in our 20s, 30s, 40s, and 50s, like life comes at you really fast. Like there's a child, there's another child, we're getting married, we're getting divorced, we're starting a business, we're changing jobs, we're being called in to help with an elderly parent. There's so much that comes at us that ultimately drives, I think I need some financial advice, some financial expertise, some financial help on this. It doesn't surprise me at all to see the demand for advice is higher in younger generations. They literally have more coming at them for which they may need advice. And when you couple that with what ultimately to me are the drivers around who chooses advice. I tend to talk about it as what I call KIT, K-I-T, which is for, do you have the knowledge to do it? Do you have the inclination? Like, do you actually want to spend your time and energy doing it? And just, do you literally have the time? Yeah. Knowledge, inclination, and time, which came through in your statistics as well. You had is knowledge, time, and sort of stress, or managing the stress, which is, do you have the inclination to do this, or do you find it stressful to do it? When we just look at those questions, like, do you have the knowledge, do you have the inclination, do you have the time? Inclination is kind of a mental thing. I think just some of us are happy to do that and be more do-it-yourselfers. Some of us are not. But for folks that are younger, we may not have as much knowledge yet, because we just haven't lived as many of these situations and have the same level of experience around navigating financial decisions. And often we don't have the time. When I'm retired, I've got a lot of time to handle some of my financial stuff because I'm not working. In my working years, I got my life, I got my job, I got my spouse job, I got kids issues, I got parents issues, I got everything coming at me, not a lot of free time. And so that combination of factors, that younger folks at the end of the day have more financial issues that coming at them, less lifetime to accumulate knowledge, and less time available to get help with it, all feeds very directly into a growing demand from younger folks to buy advice. The only challenge we've had historically was they couldn't buy it because so much of the industry required assets under management in order to do it. And one thing you usually don't have when you're still getting started is a big portfolio. So I think we had business model limitations, but the demand is there. And as business models are evolving, we're seeing more and more uptake from consumers into advice models that can serve them.
Yeah, and I don't want to jump too far ahead to the next section, but there is a perception that you have to have money, a good chunk of it, to work with an advisor, and that's something that was also a bit of a roadblock. I kind of wonder as well if some of the for the younger generations that have gone through 08, 09, cost of living increases, housing is unaffordable in many places, and now 2 years of and unstable jobs and that kind of thing is also driving that need and that desire for working with an advisor as well. Nina, is same question really. Is that something that you're also seeing when you're when you look at the market and just in your practice?
Yes, I wasn't surprised by the data. I was just glad we have an opportunity to put it out there, because I think the media has for years told stories about or given advisors direction on how to build their business or grow their business, and it's never been a story around millennials or other generations other than boomers having any money, and that's just not true. About 60% of our client base is going to be between about 25 and 55 years old. They're in their accumulation phase, and the first time I ever heard another industry expert professional say was Michael, and just what he said was that retirees certainly have financial planning needs, but you have many more financial decisions that you're making before retirement, and in my opinion, less knowledge. When you're just starting your first job or buying your first home or whatever some of those milestones, first marriage, first baby, those are all milestones that you have zero experience in the past of how to deal with that and what you need. And an advisor, I think there's a perception that we are a trader. I was not surprised by that bigger returns, because if in your mind all the advisor is giving you a portfolio of assets or investments, and they're just trading for you, and you feel like you can do it just as well for the same price, there's a massive misconception of what your advisor should be doing for you. That's why our name is not, my name is not trader, it is financial advisor. Right. And that should encompass, and I think most of the more future forward thinking firms and advisors are looking at holistic planning. We're doing the financial planning. We're talking about whole life, not portfolio return. I think another thing is, if you look at generational experience with financial advisors, and Michael, you've talked about in presentations, I've seen the evolution of the advisor. I think some of the boomer generation, their experience was more with a stock picker. It was more with someone that maybe traded a commission account and did not have a lot of relationship with them. And they did not ever have an opportunity for that relationship to change into what a financial advisor probably looks more like today. And so as other platforms or digital opportunities came out with the e-trades and some of the do-it-yourself, then they started doing that. They lost trust in what that advisor relationship was. Whereas I think a younger generation is seeing a very different look and feel of what the financial advisor provides to them. And they're also dealing with a much more complicated digital world where do they have access to a ton of information? Absolutely. Does it make it easier or harder to do it yourself? Arguably, I think harder, because you can trade your portfolio at the stoplight based on a media thing that Bloomberg that popped on your phone. There's just a harder way to filter through what's real data and what's just media driven emotion. So I think that I think we still need to do a better job at demonstrating our value. I think that one reason why you're seeing a generational difference in who wants the advice is from the experience and the way our actual profession and industry has changed in our services that we're providing to those individuals. Another thing that I think is really important to remember is millennials. I think 10 years ago, when people were more talking about millennials or training programs were saying focus on the boomers, not the millennials, etc. Well, the millennials were really in their 20s and 30s, but now they're in their 40s, late 30s, 40s. They've had bull markets, they've changed jobs, they're good savers, but a lot of them are feeding off of the experiences of their boomer parents that lived through the financial crisis. And I hear all the time when we meet with a young family or individual, and by young, I could even mean 50s. They say, I do not want to be where my parents were in the financial crisis with all of their money in their 401k with no advice. It went to nothing. And I usually say, if it went to nothing, they sold. You know, they didn't stay invested. They didn't have someone helping with those emotional decisions. But they watch their families go through, or their parents then have to tack on more years to retirement. And they don't want to be in that spot. They'd rather start earlier or check in well before retirement to make sure, even if I'm looking at 15 years out, and I'm making those good decisions now, small along the way, to make sure when I get to those years, I'm not experiencing the same suffering if there's another major market correction.
Yeah, I mean, that's all of that is very true. And I think even just again, not to jump too far ahead, you pointed out that, you know, the information that's out there for investors to sift through, and like you say, you can make a trade at a stoplight based on like a pop-up from, you know, some media outlets that just, it's too easy in some cases, but it's hard to sift through that information. Something we're going to talk about a little bit later, actually, as to where investors are getting their information. Carrie, for yourself, I mean, I know you're not directly in the advisor space, but is there, you know, any comments from yourself as to what you're seeing, and just even drawing on what Dow Jones is seeing when you're reaching younger investors with content?
Sure, I think there's a tremendous amount of alignment with both what Michael and Nina have shared here. We can see it, you know, through the content trends across all the Dow Jones properties. And, you know, with the scale that Dow Jones has, we also like to think that we have a really good window into consumer and investor sentiment almost in real time. We can see, you know, what we like to say, what keeps them up at night, but also what gets them up in the morning. And what we're seeing across a number of different segments is this interest in holistic solutions. So this isn't just about maximizing return. It's about recognizing life is complicated, the market's complicated, money's complicated, and they're turning to the Dow Jones brands to help, you know, understand that and to be empowered by it. In a lot of ways, I'd like to think that the Dow Jones brands represent almost their proxies in some ways for that sort of seeking advice. It might be the first step for some folks to say, let me understand this situation a little bit more completely. They're moving themselves down the funnel, if you will, to maybe be predisposed to working, you know, with an advisor. But the interest is definitely there on a holistic level.
Yeah, I would agree with that. And it is about you know, all three of you said this. This is about providing a full financial planning picture, a roadmap, and really not just being a trader, just an investment advisor. So, you know, that theme is very strong. It's something I believe in and had believed in when I was an advisor, and to this day. You know, we looked at one of the reasons, obviously, why investors start working with an advisor, and we saw that, you know, recommendation was the #1 reason. So, you know, just looking at how advisors can really maximize in a way, or really drive referrals and recommendations. I think it's sometimes a question that advisors are afraid to ask. You know, they don't necessarily want to ask their clients for referrals. They may go about it in various ways. Obviously, with digital tools out there, it's become a little bit easier. Maybe not. Maybe actually advisors don't know how to take advantage of it. But Michael, I'll come back to you just as a you know, what you're seeing, and some advice almost as to how advisors can overcome some of that referral hesitation. We can almost call it, like, you know, they're maybe afraid to ask for referrals because they feel they're not necessarily delivering the value that they should be. Do you have any suggestions or any comments around what you're seeing in the way advisors are actually going about getting referrals, and how maybe they can overcome some of that hesitation?
Sure. I will say, I mean, I don't think the hesitation for most of us on referrals is some belief of like I'm not that valuable and worthy of being referred. I think actually for most of us it's almost the opposite, which is like, I do all this stuff for my clients. Like, they should just see it and want to tell everyone about it, and then I'll get more referrals. Like, why do I have to ask for referrals? The results should
Right.
speak for themselves. I mean, I think
Right.
that's the kind of mentality that most of us have. And when you couple that with, you know, this is a person that I work with on an ongoing basis and have a relationship with, so the last thing I want to do is seem obnoxious or pushy by like badgering them for referrals. It kind of builds up to this recipe of, I don't really want to ask. It should just be obvious. If it's not obvious, I'm just going to try to do more for them. So hopefully they'll notice me and it'll be even more obvious.
Mm-hmm.
And I certainly don't think there's anything wrong with the idea of, well, I just want to generate referrals by serving my clients really well. But I think the fundamental challenge that we still face at this point is at the end of the day, we don't work with just anyone. I mean, most advisors have someone that they work with as a typical target client. Sometimes it's stated a little bit more concretely. Other times it's just, I've got certain asset minimums or fee minimums or other requirements, or, you know, my clients are primarily retirees or wherever it is that they focus. The problem is that when we're not particularly clear about that, because, you know, we don't want to offend the person who maybe isn't a fit that maybe we would have worked with anyways, it creates a fundamental blocking point for clients to refer, because they're literally not sure who to refer. Right? If
Mm-hmm.
my only knowledge at the end of the day of you as an advisor, as your client, is, well, I know you had a minimum of at least $500,000 because you told me that when I came to work with you, and I had more than $500,000. So that's fine. And we've been working together, and I
Mm-hmm.
appreciate that. I don't know which of my friends has at least $500,000 of liquid
Right.
investment,
Right.
nor am I necessarily going to ask them in the moment. I don't necessarily like to talk about money. So I don't even want to say like, well, I've got an advisor. She's great. Now she does have a $500,000 minimum. So make sure you've got that before you call her. Cause now we're doing this whole like, well, I've got money. Do you have money? Like, there's all this really super awkward social status stuff that's starting to come
Yeah.
into a conversation that I did not want to have with my dear friend of 20 years who I'm trying to help find an advisor, but I don't actually know how much money she has. I don't want to ask and open that door.
Right.
So we get stuck in this realm where clients literally couldn't identify who's a good referral, even if they wanted to, unless it just absolutely bats them in the face. Where like, I just inherited millions of dollars from my mother. I don't know what to do. Who do you use? Like, okay, it's
Yeah.
probably safe if I refer my advisor.
Right. Right.
But short of that, you know, most clients are not certain who to refer. And the #1 most awkward, embarrassing thing for a client is, I referred my dear friend to you and you told them no.
Yeah.
Because now I look bad because I sent my friend in to get rejected to their face. And the
Right.
easiest way I can avoid that is I just don't refer you anyone. And then
Right.
I never have to, as your client, never have to worry about that risk of social embarrassment. So the driver to that, like when you look at what turns it around to actually drive more referrals, I think Steve Wershing puts it well, that you have to make yourself more referable in the first place. And referability is not just I give great service. I mean, clearly that's a part. If you give lousy service, no one's excited to talk about you. But being referable is not just about the quality of your service. It's about making sure that the people you work with are crystal clear how to identify in their world, in their social circles, and their interactions, who would be a good fit for you in the first place. And so in practice, that tends not to revolve around things like assets, because they don't know how much assets their friends have. They usually don't want to ask and have that conversation. It tends to focus around the problems that you solve. And maybe ideally the problems that you solve that happen to be problems of people who have money, right? If I say I specialize with business owners who are having a liquidity event of a business they built to at least 20 team members, I know that's a multi-million-dollar business, because just that's how much revenue you have to support 20 people. And you're having a liquidity event if you're selling the business. But I don't have to say I only work with business owners who are bringing at least $3 million. I can say I work with business owners who are getting ready to sell their business after having built it to at least 20 team members. And I know they'll financially qualify. But now all you have to do is make sure when you're out in your social circles, if you ever hear someone say, I'm thinking about selling my business and I've got a bunch of team members, send them my way. Like, I do that. Or I specialize with the executives at such and such company who are making the transition in retirement, right? I know their financial wherewithal will be there because they're executives, so I don't have to say the dollars. I can say the problem that I solve. And so defining your market by the problems that you solve and who you work with, so that if your client was at a cocktail party, if they met that person, they would immediately know it's a qualified prospect for you. That's what makes referrals actually begin to happen.
That's very good advice. I think that's like I said, it's identifying the market, and whether it's a niche market, and really outlining the problem versus the actual asset value range, or sort of a general value prop of I provide great service. I mean, for Nina, for you, are you you can, if you in your practice are kind of doing the same thing that Michael just outlined, or different things to drive referrals, or any other comments on that?
So similar, but admittedly, in the beginning, I was really bad at asking for referrals, because the only ways I kept hearing about it were so cheesy. It's like, bring out their LinkedIn pages and say, who do you know that I know? Or, have them write down in the first review meeting 3 people that would also benefit from your services. It was just all these kind of coaching things that I heard that I really did not fit my personality, because I think you have to be genuine. And I don't think it can be on demand. I think that puts them in an uncomfortable spot. And so I sort of did a circumvention referral that worked over time. It's definitely not your quick way to get new clients, but instead we really focused on finding the right centers of influence and being very, very clear on who we wanted in our firm. And all of those centers of influence are significant clients of ours. So they know their experience. They know what they're getting. They know the investment types. So we spend a lot of time with them as clients, but also as referral partners. And it's a really mutual beneficial relationship. They get a lot of business from us. We get a lot of business from them. And they're very clear on who we work with, how we charge, etc. The other thing that we do is educational client events, and I do not mean seminars. They're educational economic forecast twice a year, once in February and then once in August. They know it's not salesy, but they are encouraged to bring someone that they believe may be of interest in our services. It gives us an opportunity for an immediate face-to-face introduction, an opportunity for us to meet them as well and have a quick chat. You can feel out a lot pretty quickly. And then also we demonstrate our knowledge and investment, thoughts and predictions, but they also see a room full of clients that seem happy. And prospects will ask the clients right at the table, hey, how long have you worked with them? So you are happy, what do you think? And so that's been a really big referral driver for us. Probably those 2 are our largest. Specifically directing clients, the only way I ever do, and I do this genuinely, is I absolutely love working with you. I'd clone you all day long if I could. If you ever know anybody else that is in exactly like you guys, let
Yeah.
me know, because I can't clone you, but I sure would.
Yeah.
And I only say that when I mean it, and I genuinely can't think of anybody in our client base that I wouldn't clone.
Right.
And I think the other thing that you run into, though, that you have to be very careful with referrals is if you tier client service and you tier your fee schedule. So what I have run into more than once is, hey, my neighbor referred me to you. I want to work with you. Sounds great. She pays 0.75%, and I'm excited to get started. And I have to say, I'm sorry, that's not what your fee would be.
Mm-hmm.
So we stick to a tiered fee schedule. So I can't disclose what that neighbor's assets are. And sometimes they both might have the expensive cars and the big homes and the great jobs, but one's a spender and one's a saver. And there's a big difference in what assets we might be working with, or someone may have inherited other assets. So
Right.
we absolutely never, under any circumstances, not even for my sister, discount or change our fee schedule, because you get in very dangerous territory to say, okay, fine, and I'll let you have that 75 basis points when you should be paying 1.5, but don't tell
Mm-hmm.
anybody. Because if you
Right.
refer somebody with $25,000, now I've got to honor it again.
Yeah.
So we just really, it's important to be very careful with your fee schedule, for one.
Mm-hmm.
And two, your client service model. If you tier that, so for example, if I have a client with $2 million assets under management and I'm meeting with them 4 times a year, they get a nice client gift, they go to a wine dinner, and their neighbor who has $250,000 isn't getting that same level of service, they're going to want to know why. And so
Mm-hmm.
you have to be very clear up front, this is my service level, and be open with that, or make it a lot less obvious on the back end, I mean, on the front end to the client's face, And so we work with multi-generations,
Mm-hmm.
and each generation has a different asset level. And so we're very adamant not to be extreme with our different client service levels. That ultimately it's all the same household and
Right.
relationship. And so we treat it as such. And, we want the money flow to keep within our firm as well. So those are two things that have worked for me as far as building the relationship.
Mm-hmm.
The referral. And we get calls every week. It does work. I mean, you will just get the phone calls and the appointments made, and it's like clockwork. It takes time, but you get people that you're looking for. But two things to be aware of: watch your fee schedule, stick to that, and your client service models.
Right. No, that's very good advice. I think that can go a long way for a lot of advisors. And I was like you early on in my financial advisory career. I could not ask for referrals at all. I mean, I didn't have digital tools to work with really, but it was just one of those really awkward things, as you guys both pointed out, that, I think I started when I was 24 or 25, so it also didn't help that I had no experience and looked, younger than pretty much all the clients I was going after. All right, so we're going to switch gears a little bit here and talk about communication and content. So this was really the second part of the survey that we wanted to look at, and what are some of the things that we saw from the survey results with respect to communication, frequency, preferences, where investors are getting their financial information. So we're going to talk a little bit about that and then jump right back into the panel discussion. So when it comes to levels of communication, what do investors expect? What kind of expectation do investors have in terms of communication frequency? So you can see here that, really what it comes down to is investors actually expect and want to hear from their advisors very frequently. The most common response given in the survey was that investors do want to hear from their advisors on a weekly basis. So, I think a lot of advisors, and something that when I was an advisor, I did as much as others, was a quarterly communication, or a monthly communication that came from the firm itself. But in fact, if there's something that advisors have that's relevant to share, then we see that weekly communication is actually the most preferred frequency. Taking a look at where investors get their financial information, this of course is, I think, critically important for advisors. And no surprise really that news sources are the #1 source of where investors get their financial information. So, I think we can all agree that there's, tons of information out there on various channels from various sources, and it's important for advisors to understand that clients are turning to credible news sources as their primary source of information. Now, interestingly, the second highest response rate and as to where investors are getting their financial information is from the financial advisor themselves. So again, we're going to talk about how advisors can actually create their own content potentially, or at least be a source of information and a source of truth in a lot of ways for clients. And then, when we take a look at the other sources, social media, family and friends. One thing I will say about social media, of course, is that social media is really more of a channel than a source per se. And so, there actually may be, and usually often is, the news sources themselves that are being delivered through social media. So it's very important in general for advisors to understand and meet their clients where they are, where they're getting their information. So if that's on social media channels, if that's through the news sources directly, then it's important for advisors to know that and really be able to deliver content through the various channels. We asked again by age and where the different age brackets again are getting their news sources. No huge surprise here that as we see an increase in age, there is a higher propensity to get financial information from news sources. So I think that probably is something that most people are aware of, that the older generations tend to want to receive their news or get their financial information from the news sources directly. But again, when we look at the various channels that are out there, it's still important to understand that the younger generations are still going to be getting information from news sources. They may just be getting it through a different channel than a publisher site or a news source site. Again, just some qualitative results that we took a look at and asked for as well. So other sources of financial information used by investors: checking the markets, gut feeling was an interesting one, advisor newsletter, family and neighbors. So again, it's just important for advisors to understand that this is, there are various means and various channels through which investors are getting their financial information. So when we take a look at the actual more detailed breakdown of the sources, so again, social media, of course, can be broken down by various platforms. So, Reddit, TikTok, Twitter, Facebook, YouTube, these were all social media platforms where investors were getting their information from. Again, some of those may already, they of course will have credible news sources as part of that. Finance blogs, another important source for investors, but far and away the most dominant source of information was credible news sources. So over 50% of investors trust news sources as their primary means of getting financial information. And of course, very importantly, I think the reason that is the case is that news sources tend to be, of course, credible, fact-checked, validated content. So when we asked, what percentage of investors felt that fact-check content was very important to them, 82%. So 82% thought that there was that fact-check content was extremely important to them, which makes a ton of sense, of course, underscoring the value of sharing content that the advisor didn't necessarily write themselves and doesn't necessarily come across as self-serving. It's important to be able to share content and understand that clients do want to receive information from credible, trusted, fact-checked third-party news sources. So we'll turn it now back over to the panel. So when we look again at that last stat, really, or the second last stat I pointed out, where 50% of U.S. investors felt that news content was the most trusted source of financial information. There's this perception, of course, that you also need to create original content in order to drive value. Now that I think there's definitely value in creating your own content, but content, of course, is expensive and time consuming to create. It does come with, obviously, again, that fact-checked grounding, where that's where investors are looking to make sure that you're not just delivering an opinion only. So getting content from trusted news sources obviously can help deliver a message that advisors want to get across. Carrie, I'm going to start with you because from the Dow Jones side, it'd be interesting to know just what goes into the content creation process, and if you can talk a little bit about what it costs. Now, I know obviously this is at a scale that's quite different than an advisor necessarily would be creating, but I think it's important to know, for all of us, and certainly for the audience, what goes into creating content, what the fact-checking process is, and really what the cost is, in a way, of creating this kind of content that advisors can use and share.
Well, the cost is something I can't share, but I can tell you it is very, it takes a lot of resources to produce best-in-class information, to the point about our reputation is what we have. And so fact-checking is essential to this. Having market sector experts is also critical. At Dow Jones, we're blessed with tremendous journalists who have years of experience covering what they cover. And I think that that's something that is not easily replicated, and something I think everyone should just always keep front and center. But I would say the earlier stat about news sources and the channel, I think, is a very important one. This is something we've pivoted to in recent years, is meet the audience where they want to be met. And that I think the point about the channel is, I think, a very important one. We are seeing significant increases in our audience on all of these, on all of the social channels. Frankly, that's how we want to just deliver information, to people where they are and where they're, comfortable in a position to receive that information. I think another thing, though, too, is for the advisors on the call, it's important to provide context, and a lot of what we do too, and with, for example, newsletters. Now, a few years ago, newsletters were 25-year-old kind of media in the digital space, and in the last couple of years, they've exploded in terms of popularity and growth and demand. And the most important thing is when you can put together a newsletter that is curated, that has context. That is really the essential thing. Even if you're not producing the content on your own, and you don't have to. I think what the end user wants, what that consumer wants, is context, and that curation is so important. And what we're finding is the demand for that content is, in fact, daily, or in some the appetite for information, especially during periods of tremendous volatility, and market trends and changes, et cetera. So curation is really important, I think, in figuring out where the best sources of information are and how to use them.
Oh, absolutely. I mean, you're speaking our language here as well. I mean, we obviously, our core business is curating content for advisors, and so you're right. It's not just a fire hose of information. It needs to be relevant and appropriate for the audience. Michael, for yourself, I mean, obviously you write your own blogs and you create a lot of content. You also do curate content. Can you talk a little bit about your content creation process and how you use curation, the same way that kind of Carrie talked about the importance of that?
Yeah. So here's how I think about it at a high level. So the Wall Street Journal is a fantastic news publication. I follow it regularly. We include articles from it in our in the curation that we send out. Nobody, but like, I don't call the Wall Street Journal for advice. I go there to read news content. I love the content, but I don't call them for advice. And prospects who get Wall Street Journal articles from me are not necessarily going to call me for advice because I gave them someone else's article. Now, it's a helpful thing. Like, I'm a cool newsletter, and maybe other people will sign up and engage, and like, that's great to build my list. But just an advisor, that doesn't get me business. Like, no one wants to give me their life savings because I clip really cool Wall Street Journal articles.
Right.
The distinction here is, ultimately, to do business with people, there's a combination that they have to feel like they're heard and understood. You have to show that you get them and the issues that they're dealing with. And then you have to be able to show that you have the expertise to solve their problems. So they need to be understood, they need to feel understood, and they need to know that you have the capability to solve the problems. So when I think about it from that domain, if at the end of the day, what I'm trying to show is I've got expertise and I understand you, one way to do that is I just make all the content. I make the content that shows my expertise. I make the content that shows that I understand you. I'm putting it all out there. I can do that with the caveat cream, as you noted, like, takes a lot of time to do that. Like, quality content takes time. So the midpoint to that, and what we execute in practice with this kind of blend of the strategies, is curation is a fine way to show I understand you. Because I'm literally going to go find the articles that are most interesting and relevant for you. If you are looking every day, every week, however long after we send it out, ours is weekly, to say, like, I love it when the advisor's newsletter comes out, because they've always got these interesting articles that, like, it's like he's reading my mind, because it's always the thing that I would want to know about. I'm like, cool. We're building a connection. I'm showing I understand you. I'm showing this connection because I'm sending you things that feel like they're a perfect fit for you. But that can't be all. Because if I don't actually at some point show up with something that I create that demonstrates my expertise, then I'm a cool newsletter, but I'm not actually a cool advisor that you hire to do business. And so, like, that's kind of how I think of the blend. You can create everything to show that you have the expertise and that you understand them. You can create to show your expertise and curate to show you understand them, which actually has a lot of expediencies to it. You can't get there by curating all of it, though. Because at some point, if you don't show up to say, I have the expertise, then you're really just like a cool media distribution channel. People may sign up for it for your media, but they don't sign up to do business with you because you're not showing the expertise at any point along the way.
Right.
So create all, or create plus curate, but understand the different functions. One is show your expertise, and one is show that you understand them.
Very good distinction to make. Absolutely. Nina, same question just for yourself. I know obviously you've written articles and you create content as well. What are your thoughts on that?
Well, early in my career, I was with a wirehouse, so I had no ability to create anything.
Right.
But I actually am a creative writer and an English major. I intended to be a writer. I don't know if I'm good at it or not, but I enjoy doing it. And so when I went independent with my business partner, I said, yay, now we can market and distinctly define our brand and different things in our market and who we want. And so I rebranded immediately. I think your brand needs to be really good. I'm a big believer in branding first and you market later, because if they go to your if you market and they go to your website and it's terrible and you've got your name spelled wrong, or it's a picture from 1999, like, it's got to be relevant. It's got to be professional. It does not have to be crazy expensive with all kinds of moving parts. It just needs to be there, present, relatable to the audience that you're trying to define. And at least some, like, information about you that is not all about, I have a series 7, I have a series 24, I have, it needs to be where people go on, and by the time they meet you, they feel like they've got a good grasp of who you are and who you're looking for.
Right.
I also believe in, so when we established our business, and we've done it so we started working together in 2009, is whatever you start doing, don't stop. It's got to be consistent. Michael, you are the content king in my opinion, but you're consistent. You have your Friday afternoon newsletter. I know when it's coming. I know what the content is going to be as far as conceptually. I know that I can read that over the weekend and take some time to digest that before my next week. We do the same thing. We do a weekly market commentary every Monday. It's purchased. It's not, which cat's out of the bag. I don't write it. But we do a quarterly newsletter, but it has nothing to do about finance. It's what's going on in our business. What charities and community organizations have we supported? What new team members do we have? And then each team member takes a paragraph and 3 to 4 pictures of what happened in their life. And people love it. We get more responses from that than we ever have our weekly market commentary. People, when we meet with clients, they say, "Oh, I loved the newsletter. I can't believe you got to take the boys to see the Dodgers play," or whatever it is. And so that makes us, it brings the personal in. And I'm not a super big, let it all be personal. I mean, we do have a defined relationship between business and personal, but people want to work with, we've always heard it, those they like, know, and trust. And so I think that helps bring in some of the personal side without spending time in each meeting. Here's the catch up, what we did. I think it's easy when you're early in your career. I kind of see stages of curation, especially right now with the digital tools. I see young advisors so eager to have a vlog, a blog, a weekly newsletter. They've got the baddest website in town, but they are not out meeting with people. And if you build it, they might not still come. You have to market yourself with networking and being engaging in front of people. And I think the digital-ish media, social media, all of that has, along with COVID and remote work and some more isolation versus community events and things, have probably hurt their opportunity, and they've had to lean more on the digital opportunities that they have. Another thing I see is once they get started and they've done all these things and they've set it up, well, now they get busy and they stop doing the things. It's not as important and it falls off. And so then they see the lull in the prospecting and the their business growth process. So I really encourage anyone that's starting content, be realistic about what you can consistently and with value deliver to your clients.
Yeah,
you can make
absolutely.
3 great videos with great production, but if you can't do it regularly with an expectation of good content, don't even start. And people are afraid of creating their own content. Well, what if it's a compliance headache? I call myself the lazy content queen. I love to be a part of someone else's content and share it to our media platforms. So social media, put it in our weekly newsletter, put it out on its own. This particular webinar is being shared across all of our social media platforms for the firm and for myself. The Wall Street Journal, as Michael pointed out, Dow Jones, organization, one of the arguably best and most respected newspapers in the country. I enjoy being asked to quote in that because that gives me massive credibility to have the relationship with that kind of organization. So I'm not just reposting articles willy-nilly. I often am quoted in them, have written them for a financial publication. I do not have a blog, never have.
Right.
And financial publications are looking for voices as long as it's good writing and good content, but they do want some contribution from our industry by the industry people. But if you can slowly and over time develop relationships with reporters, that's a really amazing way to build credibility. So you're in there, or people that have blogs or video blogs, webinars. So I've enjoyed the engagement with other industry professionals, for one, and 2, it keeps me from having to spend a ton of time on content creation. I spend it on the things I think I'm pretty decent at. And then I like to share the collaboration, or that I'm a part of this media article or this webinar. And it gives exposure to us without having to do a lot of work. There's also there's a lot of tools, and I don't use them, our marketing person does, but that can quickly make infographics that you can post to social media. It doesn't have to be a 4-page newsletter these days. People want snackable content. They want quicker and more easily digestible things. If it's just some quick FYIs. And the third thing I'll say with as far as stages of careers, I think once people get very mature in their careers, they want nothing to do with it. They're like, I've got my clients, we have a great relationship, but what they're not thinking about, I believe, is the fact that by the time the client drives to the advisor's office, they've passed at least probably a dozen competitors,
For
banks,
sure.
you know,
For
other
sure.
wirehouses, other independent firms, and I think we have to be mindful of, unless you want the attrition, you know, your book to be constantly losing clients and you're not capturing the audience of other newer, younger people, then you have to be ready for that to start happening, that trickle effect of losing
Right.
people over time.
No, I mean that's great advice, and I mean I think across all three of you heard a lot of a lot of the same message in that you got to be consistent. You have to distinguish between creation and curation, and really align yourselves with the credible the credible players out there, right? And it's going to go a long way in driving value and really getting your brand out there. So the last piece here we're going to get to is really just looking at recommendations. Just some takeaways really that we can talk about for advisors to walk away with today. We've obviously discussed a lot of important points and gone through a lot of the research, heard a lot from our panelists about some best practices and what's been successful for them. But we'll just get a little bit more into the last piece here on recommendations. So we really wanted to find out what are some of the top ways that investors felt an advisor could add value. And what we found is that, it's really about education, and education specifically on emerging trends and financial topics. It's not, even though we saw that returns and fees were a big part of, what might convince someone to work with an advisor in the first place. When we asked the very specific question about value, it really came down to education and understanding the goals of the investor. What are my goals and what are my family's goals, understanding that better, and delivering content that is more personalized to my interests and my goals. So 3 really important points that advisors need to understand, and again have very much complete control over in a lot of ways. That this is an area where they can add a lot more value, and of course it does again underscore what investors want. So again, when we looked at some qualitative reasons as to what some of the other sources of financial information that are used by investors, and what are some of the reasons given as to where value can be added. I think the first one's really important. Don't try to fit me into a predetermined box due to my age, right? And I think that's something that I certainly was guilty of when I was an advisor early on. It was just I think you have age brackets in your mind as to what may resonate with different age groups, not necessarily understanding the unique needs of different age groups. There may be 25-year-olds who are very interested in estate planning already, and there may be 75-year-olds that are very interested in crypto and NFTs. And so those are the types of things that you need to understand at a more personal level. But you can see here from some of the responses that it comes down to education, information, communication. We're just coming to a close here. The last thing really is, and I know there's been recommendations throughout the discussion today. So, just as a quick kind of final piece from each of you, just wanted to really get your take on the top ways that you feel an investor can add more value, right? We in our survey results found that a lot of the comments and just the responses were about educating me. Don't fit me into a box. Make sure that you're personalizing your recommendations to me. So just as a last thought from each of you, Carrie, any thoughts and final comments, recommendations on how you feel advisors can actually drive more value to their clients, their prospects, and just really really articulate their value proposition?
Well, I think we've covered a great deal of that. I would just say, I understand that you have a very motivated client or prospective client. The interest level is very high, and I think advisors would be very wise to lean into that. And if education is what they're looking for, or market analysis, whatever it may be, there's a receptive audience there. And I think that, as a publisher, we recognize that as well, and we are trying to do many different things, and the receptivity has been very good. So I would just say, lean into that experience and that opportunity that you have right now, especially with this younger and emerging investor cohort.
Great. Nina, yourself?
Well, I think if anything, every person that watches this webinar should be excited, because it just really obviously sheds light on even bigger demand for our services from people than we expected. I think the boots on the ground of us that have been serving this demographic, and actually all of the ages across the board for many years, have seen that and really are seeing it grow, which means that there's a lot of opportunity. There should be nothing that was heard that should be overwhelming. It really means they're asking for us to do a good job, give them access to our services, and to be transparent really about the fees and value add that you have, and just be consistent in your communication. That's not asking us to reinvent the wheel. That's just asking us to show up, basically. And so I think if you really look at the data that was presented, it's nothing but extremely positive for every financial advisor in our industry to do exactly what Carrie said: lean into it and find 2 things from this webinar that you can take away from and implement to your practice or business, and start to attract that demographic that is actually saying, I want your help. They don't want the Robin Hoods and the Betterments and these platforms that we were scared of. These, the robo was such a big topic for so long. They're saying, I want you, I want the person.
Right. Perfect. Michael, last word goes to you.
I would just say that the value discussion to me at the end of the day comes down to just the client's perspective. They could have called an advisor at any point up until now in their life. For some reason, they chose today to come in and meet with you. So something's wrong. Something's so wrong that this was the day they decide they're going to do something about it. And so to me, the core issue comes down to what actually brought them in the first place that you're here to solve. Now, as you noted in the stats earlier, Kareem, for a lot of people, the problem they come in to solve is, I'm unhappy with my portfolio's returns, I want something better. So like if your value proposition is better returns, like, good news, there actually is a very widespread demand for it. It's like, if that's your thing, if you're good at that, more power to you, and you're going to have a lot of people to talk to, because there is a natural demand for that. For those of us who aren't necessarily in the business of simply trying to produce better returns, we're trying to do other things, we're trying to be more holistic, or we're just trying to find other value opportunities because we feel it's difficult to beat the markets. That to me is where it gets a little bit more interesting, because it really comes down to what is a real world client's problem. What it's not, and again, your statistics showed this well, Kareem, what it's not is, I want financial planning. I mean, that's what it's not. Like, no one wakes up in a cold sweat at 2 o'clock in the morning saying, I have to get a financial plan. Like, I'm not gonna be able to fall back asleep until I pull out my smartphone 2 o'clock in the morning, start surfing the web and finding some solution to this, right? These are not the problems that keep us up at night. It's other things that speak more directly to the financial pain points that we're having and that we're worrying about. And so when we get into the business of solving those problems, that to me is when value shows up and when prospects show up. If we're talking about this in the context of younger clients we have, like, it's not, frankly, it's probably not about their assets or their portfolios at all. It's about their income. Like, you want to help a person in their 30s and 40s, help them negotiate a raise from their job, or find a different job that will pay them more. If you can help them with their salary 10, 20, 30%, that is a literal lifetime change in their trajectory of wealth accumulation. If we're working with business owners, sometimes it's not about doing what everyone else does, it's about the different stuff. A lot of advisors like to work with business owners because they have liquidity events, so we want to get to the liquidity event. Well, what if your specialization was helping business owners with family succession plans where they're not going to sell? No one even calls on them because most advisors only call the ones that are going to sell and get a big check. So we have opportunities in saying, hey, you want to solve your business by not selling out, by making it a generational thing for your family. I can help you with that. Even when we get into the domain of retirement, we tend to spend a lot of time on retirement portfolios. But when you look at what worries retirees most, it's not their portfolio, it's their health costs.
Right.
It means if you really want to specialize in retirees, becoming a Medicare expert and an aging in place expert so that they can age in their home that they love and want to stay in is actually our opportunities to provide value. And what does it look like if your agenda talks about the wheelchair modification they're going to make to their house so that they can stay in it as they get older, not what did you get on your portfolio last quarter? So translating our value into the problems and things that they face, the stuff that actually keeps them up at night, which as much as I love and champion financial planning, it's not literally financial planning. The planning is a process about how we get to the answer, but the value comes in solving the problems. And so the more that we get focused on the problems that clients are actually having and facing that keep them up at night, the more value we get to deliver and the more they seek out our services.
That's a great note to end off on, solving people's problems. Absolutely. I mean, that's what it comes down to. So want to thank all our panelists today, Michael, Nina, Carrie, thank you so much for your time and your expert insights. And certainly hope I'm sure the audience will leave with some great recommendations and information today. So thank you very much. And want to say thank you to Dow Jones for their help on putting together the research and today's webinar. And of course, if you wanted to learn how to put some of these recommendations into action, please visit advisorstream.com/research. Thank you very much. Have a great day.